Good evening, everybody. My name is Jerry D'Ambrosio, Senior Instructor with VectorVest, and it's my pleasure to present tonight's special presentation titled How to Get Inside the Mind of the Active Trader. Investors look for favorable relationships between price and value. They look for safety, rising earnings, and good sales growth. Traders base their decisions off of attractive situations with price and volume. As much as we try to keep our emotions out of our trading, they play a huge role, especially at turning points. While we cannot predict the direction in which a stock will move, candlestick patterns provide a glimpse into the future and allow traders to identify bottoms and tops with pinpoint precision. Now, no matter if you are an investor where you're holding on to a stock for a few months, maybe a few years, or a swing trader where the ideal holding period is a few days, maybe a few weeks, or even the day trader where you're closing positions at the end of every trading day. Market situation needs to be the first consideration that you make. For example, here is the VectorVest views on February 12th of 2016. It says the price of the VectorVest composite fell 45 cents per share over the last 5 trading days and closed at $32.43 per share today. The primary wave remained down, and all of our key market timing indicators, the BSR, RT, and MTI, moved lower for the week. But a ray of hope comes from the bullish candlestick patterns of Thursday's and today's price action. The top 5 one-day Derby winners have all been bullish for the last 3 days. So while the trend of the market isn't quite up yet, folks, the tone here in the strategy section is what we call cautiously optimistic, right? On February 11th, which is the day before the views came out on this Friday, we noticed and recognized a bullish candlestick formation. So this is the market timing graph back at the beginning of January 2016 heading into February of 2016. And there is February 11th, and the VectorVest composite on that day formed a hammer. A hammer is a bullish candlestick formation that appears in a bearish environment, in a downtrend. We can clearly see the market was falling, just hit a new low, and we see that hammer. Hammer is formed where the lower wick is at least twice as long as the body of the candle. So again, the bullish hammer appears in a downtrend, and what it does is it sells off sharply following the open. After the decline ceases, the market almost returns to the high of the day. Now this is a filled or a solid red candle, so the close of the day was below the open. So this observation here of the market closing well off of the low of the day kind of reduces or minimizes the previous bearish sentiment. Now this causes short traders to be a little bit alarmed. They really feel that the downtrend is damaged and that upside potential is likely. We got nice follow through on that following Friday. Okay, so on February 11th, the VVC formed a hammer. We got really nice follow through on the following day. Now, back in January, on January 20th, we observed what's called a dragonfly doji. Now, it's a doji, so it means that the opening and closing prices of the day were virtually the same. Dr. DeLita wrote about this in the views on January 20th. While that dragonfly doji didn't lead to an explosive rally, what we're starting to see here, folks, is a change in sentiment, and that's what candlestick patterns tell us. They help us indicate changes in the emotions of traders and help us identify potential turning points. Okay, so what you want to do from here is incorporate or couple market situation with a stock selection methodology. So if you observe a candlestick formation on the market, let's start looking for stocks that are exhibiting a similar pattern. So here's an example, IGD. Back on February 11th, IGD formed a hammer. Stock was clearly in a downtrend, so we're still in a bearish environment heading in to that hammer. On this day, the stock opens lower than the previous day's close. It actually gaps down, sells off, causing that long lower wick, but then buyers come in, push the price of the stock higher, closing near the high of the day. Now with a hammer, confirmation is the body, the top of the body of the hammer. And we got confirmation the next day, And boy, that would have been an outstanding trade to take on. Now, prior to that, we actually had another hammer. Now, we didn't write about this in the views necessarily, but on January 21st, you had another hammer. Okay? This didn't lead to an explosive move, but we're starting to see a change in sentiment. And what I love about this hammer here on February 11th is it was formed right at support, right at the same level that the previous hammer was formed. We did get confirmation the next day there, so theoretically you could have taken that trade on and you had some nice profit potential there. Same date, February 11th. Again, we're using the market consideration and situation first and then looking for stocks exhibiting similar patterns. So here's ROL. Here we have a dragonfly doji, very similar to the type of doji that we saw on the market just a few slides back. Dragonfly doji occurred while stochastics was oversold, and stochastics, folks, is the confirming indicator. It's an outstanding indicator that identifies overbought or oversold price situations. When stochastics goes below 20, that's indicating an oversold situation. When it goes above 80, that's indicating an overbought situation. So what I like to do is I look for situations where stochastics is below 20. Then I start to look for changes in direction, right? Bullish candlestick formations. If stochastics goes above 80, I start to look for bearish candlestick formations. So ROL on the day that the VVC formed a hammer, we have a very similar pattern called the dragonfly doji. Long lower wick, so the stock actually opens lower than the low of the previous day and sells off sharply, okay, evident by the long lower wick. Sellers aren't able to sustain that drop, and buyers come in late, push the stock's price higher than the low and near the high of the day. We get confirmation the next day, and we take the trade on, and what a beautiful trade that would have been. Prior to that, we had what's called a bearish harami. So now, what do we look for? We look for stochastics to be overbought. We get confirmation the next day. You could see that the uptrend here is damaged, and the stock steadily moves lower. You take the trade on down here off of the dragonfly doji. You start to look for situations where stochastics is overbought. And now, look at what we see. We see another bearish formation called a one black crow. This is when the opening price of the day is lower than the previous day's close, and the close is lower than the previous day's open. There's your confirmation the next day because the price of the stock goes below the close of that solid red candle, and there's where you take the position off. Back on November 4th, 2016, here's what the views said. So the price of the VVC fell 65 cents per share over the last 5 trading days, and the buy to sell ratio closed at 0.21, indicating a very oversold market condition. It had closed at 0.20 on Thursday and climbed as high as 0.27 today as bargain hunters bought stocks. However, mid-afternoon profit taking took the BSR back down to 0.21. So those two sentences there, folks, we can get a sense of what a candlestick might look like on a market timing graph. It says anything can happen next week. The market could rally explosively, so stay alert for a chance to win big time if you get it right. Here's the VectorVest composite. There is that day, November 4th. So again, when you read the views, you get a sense of what that candlestick might look like. Open lower, bargain hunters came in, pushed the price of the market rather high that day, but buyers weren't able to sustain that rally. Sellers came in late, pushed the stock market back down to near the low or the open of the day. That's called an inverted hammer. Kind of take a hammer that I showed you earlier and you flip it upside on top of its head. The following day, what did we say? We said the market could rally explosively, so be alert. And look at that. On November 7th, the VVC formed what's called a Maribozu. That's a very strong bullish formation where the opening price of the day was at the low and the closing price of the day was at the high. So here's an example here, folks. On November 4th, and actually a day prior, because on November 3rd, CECE formed an inverted hammer. Now this was a day before the VectorVest views. But remember what these formations tell us. They help us identify turning points and changes in sentiment. So we actually started to see the change in sentiment here a day before with that inverted hammer. Stochastics, you can see at the bottom, very oversold below 20. So the long upper wick suggests that buyers now are entering back into the picture. Clearly we're in a bearish mood, right? The stock is falling, solid red candle after solid red candle. You get this big long upper wick on November 3rd. Following day, the stock forms a gravestone doji, November 4th. That was the day that the views came out and said, be alert for a rally. Market characteristics on that day suggested that we may have seen the bottom. The BSR was below 0.2. Market rallied nicely during that day. As you can see, the stock did as well. Volume is starting to increase as well. We got follow through the next day. Now we're starting to see higher lows and higher highs. And there's where you take the trade on, guys, where you see that change in direction, that change in sentiment. Here's another example, ERE. Here's a gravestone doji. Okay, gravestone doji, basically the opposite of a dragonfly doji, where the opening and closing prices are near the low of the day. Look at that long upper wick. You can't ignore the fact that buyers were able to push the price of the stock that high that day. I know that sellers came in late, they pushed the stock back down near the low, but look at where stochastics is, very oversold. Very long upper wick suggests that, again, buyers are entering into the picture again. And clearly, we see a change in sentiment. The following day was actually an inverted hammer. Okay, remember, upper wick twice as long at least as the body of the candle. 2 bullish candlestick formations in a row. Follow through. There's your change in sentiment. Here's another subtle example on the market. Not such a glaring example as November 4th. March 22nd, the VVC formed a hammer. Right? Long lower wick, at least twice the size of the body. Here's CEN on that day. So what do we look for? We don't necessarily have to only look for candlestick formations that meet up or line up with the market. I want to look for any formation, any candlestick formation that I feel has the possibility of turning into a good trade. So CEN is a perfect example. Oversold stochastics, there on that day, the same day the VVC formed a hammer, this stock actually formed an inverted hammer. Very long upper wick. We're obviously still in a bearish environment, right? Stock is hitting a new low. But that long upper wick suggests that selling pressure is diminishing and buyers are starting to come back into the picture. Follow through the next day, and that would have been a nice trade. Now, just a few weeks prior, folks, we had another hammer. Okay, back on March 9th. However, that was an unconfirmed hammer. Why was it an unconfirmed hammer? Well, remember where confirmation is. Confirmation is if price crosses above the body of the hammer. Well, it never did. Okay, never did the next day, never did the following day. So that's referred to as an unconfirmed candlestick formation, in this case a hammer. Another example here, ACHC. Same day, there's your hammer. Bearish environment, stock is hitting a new low. Long lower wick, at least twice the size as the body. Top of the body is your confirmation. We get confirmation the next day. Now this wasn't a home run trade, but remember folks where you're entering into the trade. Right as price confirms that bullish formation, so you're entering in somewhere on the next day. Well, the stock goes from maybe $1 below 40, maybe 39, all the way up to about 45 bucks. So that's a nice close to 10% gain. Then what do we see? Well, we see stochastics entering into the overbought situation, and we see another bearish candlestick formation called a bearish harami. We talked about this one earlier. What also are you seeing? You're starting to see lower highs, right? So you're in the position down here. You got a nice close to 10% gain. You recognize that now sentiment might be changing. You got a bearish harami. You're starting to see lower highs. You got stochastics overbought. You look to take your gain off the table. If we look back a month prior, stock is in a bullish environment, right? Stock is rising, moving higher, unfilled green candle after unfilled green candle. You may be long the position. Then on this day, you see the stock gap open and shoot up all the way up to a high of about $47. Well, the buyers weren't able to sustain that move, and sellers came in, pushed the price of the stock near the low of the day. It's called a shooting star. That's a bearish formation. Look at where stochastics is. It's overbought. In fact, confirmation on that shooting star came the following day in the form of a hanging man, which is another bearish formation. Looks very similar to a hammer, right? But a hanging man occurs in a bullish environment and at tops. And I'm going to leave you folks with another stock. This is NVIDIA. This is a stock we're all familiar with. Sure, a lot of you made a good deal of money on NVIDIA. However, end of 2016, entering into 2017, NVIDIA went through a pretty rough patch, as we can see. So as an investment, I think we'd all agree we're not making any money on NVIDIA, just simply buying and holding, right? But if we look back to the end of December 2016, we see stochastics overbought. We see a really solid and strong bearish engulfing pattern. The engulfing pattern is formed where the opening price of the day was higher than the close of the previous day. The close of that day was lower than the open of the previous day. So that filled or solid red candle completely engulfs the previous green candle. Now, if you are long the position here, and it's a trade for you, right? You may look to exit the position. You could see price continue to fall immediately after. Now what do I look for? I look for stochastics to enter into the oversold situation again. And now we have another formation. I love this one too, because where is it occurring? It's being formed right at support, right at the most recent swing low here. This is called a bullish piercing pattern. The open lower than the low of the previous day, and the close higher than the midpoint of the preceding red candle. Confirmation the following day, you buy the stock right back. You ride that baby up, and where does it stop rising? It stopped rising right at resistance. Here we have another shooting star. Look at stochastics overbought. Okay, good idea to take your gains off the table, because what's the price doing? It's failing to hit higher highs again. There's another hammer now. So what do we look for? We look for stochastics to be oversold. We see a hammer. Great. I look to enter into the position the following day if price confirms. Well, it never did, right? But what did the price of the stock form the next day? Well, it formed another hammer. Okay, so now I'm just getting ready to enter into the position the following day if price confirms, and we can see that it did. You ride that baby up, okay? And now stochastics enters into the overbought situation again. What do we see again? We see a bearish formation called a one black crow. Good idea to take your gains off the table, because you can see that price has broken down quite a bit. All right, folks. Well, I hope you're asking yourself this question. You know, how can I get started trading these myself? Well, you have a choice. You always have a choice. You could do it the slow way. Now, maybe take some of the things that I taught you here today and learn by trial and error, or do it the fast way. I'm an impatient person, generally speaking, so I like to do it the fast way. So what we've done, guys, is we've created a candlestick workshop called Master the Art of Candlestick Analysis. This is a 2-day workshop, and we're holding it via live stream. Now, we would love for you to join us at our University Training Center on July 14th and 15th in Cornelius, North Carolina, but we understand if you can't make it. From the comfort of your own home, you can join us for this 1.5-day workshop. So what you'll learn at this workshop: number one, you'll learn to profit from piercing and cloud patterns and the proven technical indicators that complement them. We're going to focus on market conditions that offer the best odds of success. And you're going to learn to utilize the power of VectorVest search engine to quickly find your favorite candlestick patterns. And more importantly, folks, what I think separates this workshop from a lot of the other things you may be able to do on your own is we're going to show you the precise entries and exits for each trade, plus a whole lot more. So there's the website, folks, www.vectorvest.com/candlestick. That website will be in the VectorVest views this week, and you can save $100 by signing up at our early bird price of only $695. And that early bird rate does expire July 7th. Now, the regular price is $795, but if you are an elite subscriber, you pay half off the regular rate of $397.50. And if you don't know if you're an elite subscriber, just give our support department a call and they'll let you know. Here's the agenda, folks, for day one. And what we're going to do is start off with an introduction to candlesticks, and we're going to talk about dojis, gravestone dojis, and dragonfly dojis. And what I love about this course is each presentation is accompanied by a lab. You know, this is the way I learned how to trade these formations. And I got in and I looked at graph after graph to help me identify those formations. And it really becomes second nature once you do that. So I really pushed for labs to be included in this workshop because, again, that's the way I learned the fastest. We'll talk about hammers and hangingmans and engulfing patterns and harami patterns all on day one. And then day two, we'll talk about piercing and cloud patterns and white soldiers and black crows. And again, each of these presentations is accompanied by a lab. As a bonus, I'm offering 4 live hour-long group coaching sessions. We're going to do this via webinar. And you guys are going to have a lot of questions, I'm sure. So I wanted to help you guys out as much as I could after the course is over. So it will begin the following week after the workshop, and there will be 4 one-hour coaching sessions that will just talk about tips and techniques, and we'll target where you guys need it the most. And those coaching sessions will be recorded. If you have any further questions, folks, don't hesitate to give us a call. Steve Chappell and myself will be teaching this workshop, and we both look forward to working with each and every one of you. So have a great weekend, folks. We look forward to working with you.